Good evening, ladies and gentlemen. Thank you for standing by. Welcome to GE Shipping earnings call on declaration of its financial results for the quarter and year ended March 31st, 2024. At this moment, all participants are in the listen-only mode. Later, we will conduct a question and answer session. I now hand over the conference to Ms. Anjali Kumar, Head of Corporate Communications at the Great Eastern Shipping Company Limited, to start the proceedings. Over to you.
Thank you, everybody, for joining in today, and welcome to the earnings call for our Q4 and FY24 results. I'd just like to take a minute to introduce our panel today. The presentation will be made by our Executive Director and CFO, Mr. G. Shivakumar, and followed by question and answers from all of you. To handle the questions, we have, of course, Mr. Shivakumar, and we also have from the management team, Mr. Rahul Sheth, who will also take questions along with him. So handing over to you, Mr. Shivakumar.
Thank you, Anjali. Good evening, everyone, and thank you for being here for our conference call for the Q4 and FY24 earnings presentation. First of all, standard disclaimer. We are not intending to forecast and we don't intend to give guidance on future profitability. Please keep that in mind when we have our Q&A. Highlights are that we had our highest ever reported net profit of 2,614 crores consolidated. Our consolidated NAV has moved up to about 1,400 rupees per share as of March 24. We have declared a fourth interim dividend of 10 rupees 80 paisa per share, taking the dividend to for the year FY24 to 36.30 rupees per share, which includes a special dividend of 7 rupees 50 paisa per share on the occasion of our 75th anniversary. You would have seen our P&L. I'm not going to spend too much time on it. We are, of course, net cash on a standalone and a consolidated level. On a normalized basis, the last quarter was our highest ever quarter in terms of net profit. The previous highest quarter in our history was Q4 FY23, where we had a net profit of 662 crores. This quarter we had a standalone net profit of 701 crores. On a consolidated basis, also this is our best quarter at 851 crores net profit. Looking at the NAV per share, on a standalone basis, we have gone up from 962 rupees per share in March 23 to 1,127 rupees per share in March 24. This is after paying significant dividends during the year. On a consolidated basis, as I mentioned earlier, our NAV has moved up from around 1,160 rupees per share, the midpoint of the range, to around 1,400 rupees per share. I won't go through this. This is just the trend of the EPS, quarterly EPS. Looking at what happened during the quarter, just in terms of the rates, and then we'll go into what went into those rates as well. Crude tankers did significantly better. Crude tankers, product tankers, even LPG did significantly better than they did in Q3 FY24. In the case of crude and product tankers, it was because of the spot markets being high. In the case of LPG, it's because we went off a contract at a certain rate and we repriced that contract at a significantly higher rate. All our LPG ships are on time charters. Dry bulk rates were a little lower than they were in the October-December quarter, but the tankers more than made up for it. Looking at the year, you can see that crude tankers were marginally better in FY24 than in FY23. Product tankers were a little worse, though still at very profitable levels. And LPG carriers, because of the repricing of contracts to slightly higher levels, did a little better than in FY23. But dry bulk was significantly weaker in FY24 versus FY23. Looking at the standalone NAV, I mentioned that 960 went up to 1127. 190 rupees came from cash profit, which is PAT plus depreciation. Fleet value change contribution to this was insignificant. So a large part of the NAV accretion has come from cash flows and cash accruals. Out of this, we paid out 35 rupees in dividends during the year, and therefore the NAV went up by about 165 rupees per share. 5 years movement in standalone NAV. So we have a CAGR of 25% between March 19 and March 24. If you look at consolidated, also it is a similar-ish CAGR, because we were at about 450 rupees per share in March 19, and we are at about 1400 rupees per share in March 24. This does not take into account the dividends that have been paid in the interim. Consolidated changes in consolidated NAV, again 226 rupees per share in cash profits. We had some fleet value improvements on the offshore side, so that contributed 41 rupees per share. Let's take a quick look at what happened in the shipping markets. As I said, the markets were possibly slightly weaker than they were in the previous year, the spot markets. So in Q4, we had a year-on-year drop in earnings for crude tankers, basically because we had a very strong quarter in Q4 of last year. However, it was stronger than in the immediate preceding quarter. Product tankers earnings were higher year-on-year. One of the factors which came into play was the tension in the Red Sea, which led to significant rerouting of global tonnage around the Cape of Good Hope. Red Sea transits for tankers dropped by about 40% in Jan to March quarter as compared to the previous quarter, which means more ton miles for tankers. Overall, the trade declined slightly for crude tankers, however, made up by the ton mile impact. Order book for crude and product tankers have built up, but are still quite low, and we will see that in perspective in a couple of slides. Dry bulk, we saw the markets recovering a little bit for the larger size ships. So we saw the Capesize going up from $15,000 on average in FY23 to $21,000 on average in FY24. You will recall that the previous year was the year of the sub-Capes performing well because of the mini bulk commodities doing well. Now it's the large commodities which have done well, and therefore the Capes have outperformed. So we saw the Supramax earnings drop from $18,000 a day to about $12,000 a day, FY23 to FY24. Again, I must reiterate, these are not our earnings. These are market earnings that I'm talking about. These are market indices. So we had an unseasonally strong quarter in Jan-March, traditionally a very weak quarter. Typically the Chinese New Year, Brazilian weather impacts tend to push rates down in Jan to March. However, this quarter was very strong, and therefore Capesize spot earnings, you can see this number, 175% higher year on year. Even the sub-Capes were much higher compared to the previous year. So we had significant supply of iron ore coming from Brazil, which moved into China, and Chinese iron ore imports continue to be strong. Coal imports into China also continue to grow strongly as a result of lower coal production, domestic coal production in China, and greater coal demand for electricity generation. So the Red Sea disruption also impacted here, where again you have between 40 and 50% of ships routing around the Cape of Good Hope. Asset prices here firmed up 10 to 15% in line with the growth in earnings. The order book continues to be fairly low at less than 10% of the fleet. In LPG, just to reiterate, our ships are not in the spot market. They are on time charters, but the market was strong. FY24 was much stronger than FY23. and the order book has built up quite significantly. We are at about 20% order book for VLGCs. Asset prices are at all-time high levels for LPG carriers. One of the significant factors over the last 6 months has been the two canal disruptions and two very important maritime choke points, potential choke points. As I mentioned, Suez Canal trade dropped by 40 to 50% from a year earlier, while trade through the Panama Canal also has been affected. This happened since October. Drought at the Panama Canal has posed restrictions on the number of ships that can pass through the Panama Canal on a daily basis. So that came down from about 32 to 34 transits per day, down to, at its lowest point, 20 transits per day. Now it's coming back up because they've had some rains and the levels are improving. But you can see the graph there. If you see the blue line on the right, you can see the increase in transits around the Cape of Good Hope, while the transits through the Suez Canal have dropped off significantly starting in January. On the other side, you can see the gray line, which is the Panama Canal, where you can see from October onwards, the transits have dropped significantly. This mainly affects exports from the US to the Far East, which used to transit through the Panama Canal, from the US Gulf to the Far East, which used to transit through the Panama Canal, especially LPG, which then had big ton-mile impact, and we saw LPG spot rates going up to $100,000 a day in December, January. Looking at fleet supply, we have shown this slide very often. As I mentioned, you can see the purple line, the current order book for gas carriers is at about 25%, while the order book for the other three kinds of ships are quite low in historical terms. And just to put so on the flip side, there are only two permanent things in shipping. One is new ships coming into the fleet, and the other is ships being removed from the fleet due to scrapping. We've seen scrapping being at very low levels. The average scrapping percentage over the last 5-6 years has been only about 1.5%. And a lot of old ships are still around because the markets have been reasonably strong. All of this sort of gives a cushion in a weak market where a lot of these older ships, which are only able to operate because of the strong market, will have to go or will tend to go first in a very weak market. And we thought we'd put this in a graph. The y-axis is the percentage of aging fleet, and here we've defined the aging fleet for bulkers and tankers as those above 20 years of age, and for LPG carriers as those above 25 years of age. So if you see, for instance, the crude tanker order book, which is at about 7.5%, the order book is 7.5%, but the fleet which is old is 18%. For dry bulk carriers, the order book and the fleet are and the old fleet are about the same. In product tankers also, you will find that while the order book is 15%, the aging fleet is also a similar number. It's different for LPG. LPG is a commodity which has seen very strong trade growth, and where we've actually seen the fleet going up 2.5x in the last 10 years. Looking at asset prices, we have mentioned that asset prices have been very high for quite some time now. So they continue to go up, and in recent months, we've seen dry bulk asset prices also move up quite sharply. Looking at great ship, this is a little bit of background. FY16 to 21, we had a very challenging period for great ship and indeed the entire industry worldwide. Utilization levels across asset classes were very low. Charter rates came down to levels which generated basically no EBITDA. If you were lucky enough to get a charter, and a very large part of the industry went through financial restructuring or reorganization. In our case, we paid down a lot of debt thanks to our risk management and having a lot of contract coverage. We were able to come through it unscathed. We had minimal cash depletion. We paid down a lot of debt. And post FY21, utilization levels have improved, the market bottomed out, and E&P activities have started to increase. Contracts are getting repriced. Every contract gets priced at better than the previous employment contract of that asset. So if you have a vessel coming off charter, let's say a 3-year charter at X dollars per day, typically the repricing would happen at 1.5 to 2X dollars per day. So the business has now come back to profitability. Utilization, there's been a gradual improvement. This is up to March. Now, in the month of April, we've had a little bit of a setback for the global jackup market. Saudi Aramco had announced earlier in January that they are scaling back on their targets of reaching a 13 million barrels a day production capacity, and they're going to take it back to 12 million barrels a day. This has been seen in action in the last month or so, where they have either off-hired or suspended contracts on, at last count, about 22 jackup rigs, and leading to a drop in utilizations. So that market is in a bit of a state of flux now. So it remains to be seen what happens now next to that market. We won't go through fleet supply. Let's look at what assets we have up for pricing. We have 12 vessels up for pricing. All of them have been bid into tenders and businesses, whether in India or overseas, and are in a reasonably good position to win business. The one thing which has happened is that our rig, Great Drill Chetna, which comes off contract which is scheduled to come off contract in end of June, that's end of next month, and where we had bid into a tender. That tender has now, in India, that tender has now got cancelled. That was a 3-year contract. That tender, we have just received news that the tender has been cancelled, so we will look at what other options are there. Typically, rigs which are working in India during the southwest monsoon, and which are due to complete their contracts during the monsoon period, typically get extended through to the end of the contract, to the monsoon period, because they cannot move during that time. So let's see what happens with the Chetna, and we'll look at what other employment options there are as well. Coming to financials, we've seen this graph before. We levered up to expand between FY17 and FY19, and then we reduced our debt by sheer cash flows coming in from the business. So we have about $350 million of net cash currently. And share price to consolidated NAV. Our consolidated NAV, as I mentioned, is about 1,400 rupees per share, and our stock continues to trade at a significant discount to that net asset value. Just touching on what we do on the CSR front, we have, since 2015, when we started our foundation, we have partnered with 49 NGOs. We've helped reach good outcomes for more than 1.5 lakh students. We have helped good health outcomes for almost 1,20,000 women and children, and we have provided livelihood for around 42,000 women through especially providing entrepreneurship training and helping them to set up small business. These are a list of our CSR partners. All details are available on our website, and we would invite you to go and check it out. We are very proud of what we have achieved on the CSR front. Thank you. The other thing is, on the presentation, you'll find the link to the coffee table book. We invite you to take a look at that as well. Thank you. And now we can go to Q&A, where we'll be happy to take your questions.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. To ask a question, please click on the Raise Hand icon tab available on the toolbar or on the QA tab available on your screen. Kindly turn on your mic when the operator announces your name. You may also post your text questions on the QA tab on the screen. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from Rajesh Khater, an individual investor. Please go ahead.
Hello, am I audible?
Yes.
Yeah, okay. Your maximum fleet is in product carriers and dry bulk carriers. Almost 34 out of your 44 ships are in these two segments. What is the reason that you have positioned yourself more on product carriers and dry bulk carriers so disproportionately, especially when you say that LPG trade has been growing significantly over the last many years?
Yeah. It is not a conscious strategy. We are quite agnostic to what sector we invest in. LPG, actually, we entered the VLGC sector specifically, and we have 3 VLGCs, very large gas carriers. We actually entered it for the first time in 2012. So we made a start there, and yes, we have only 4 of those vessels, but they've been very profitable. It's not that the product tankers have been less profitable than the gas carriers. All I mentioned was that it's been a significantly growing market. And for us, the growing market really doesn't make that much of a difference because we are not that big that we need a much bigger market to grow. There's enough space to grow even when the market, we are a very small proportion of the overall global fleet. So it's not a conscious decision to have more product tankers. It so happens that we have it. Rahul. Yeah.
So we have seen historically that it's not that one segment has outperformed the other segment materially. At different points in time, different segments have done well. So whenever we are looking to invest our capital, we are always weighing the decision between one sector or the other. So it can be a situation where at one point in time you have more crude tankers than product tankers. We are not wedded to one particular sector.
So going forward also, when you decide to invest your capital in buying new ships, will you have any affinity for a particular sector, or there's no such thing in mind?
No, we have no particular affinity to one sector over the other. We will always look at relative pricing between the sectors if the capital is limited. And it also depends on where you are able to obtain the ships, because in the second-hand market, you also have to have deals that you can transact. However, a broad goal, which is which the company always tries to focus on, is to be diversified across various sectors. Now, the level at which you're diversified between different sectors may vary from time to time, but we have seen that different markets may do well at different points in time, and other markets may do poorly at different points in time. Therefore, to be diversified is more important.
But to answer your question, if we have an opportunity to buy, say, a gas carrier, let's say the markets come to the levels at which we would like to buy. If we have to make at any point we will look at which is the ship to buy, which is most likely to give us the best possible return. It's again like a portfolio manager. You have to look at, sometimes when you have scarce capital, you have to try to allocate it to the best possible
opportunity.
Yeah, because I think you mentioned that LPG trade has grown about 2.5 times over the last many years, whereas the crude trade has probably come down, right?
It's not come down. So again, I will reiterate, it doesn't matter whether the trade has grown or not. What matters is the investment returns that you're making from that business. So in crude, it is not that the crude trade not growing, and we are an international shipping company. The crude trade not growing does not mean we can't grow. We can be 5 times our size in crude tankers without making a dent in the market, without being too big in the market. So the growth of the actual trade is not really a factor here when we are thinking of purchasing. We are looking purely at what is the return that you can make from that asset.
Also, one more thing just keep in mind is that when you look at trade is a factor of 2 things. One is the total amount of cargo that has moved, and second is the distance that that cargo has moved. So you can have a situation, and if you see the tanker market before the war and post the war, the amount of oil on water has changed marginally higher. However, the ton mile, which is the distance traveled, has increased substantially because of the war and the change in the trading pattern. And because of that, you have a much higher tanker rate. So, and also you have to always keep in mind also the supply side. You can have higher growth in demand, but you can also have higher growth in the supply of ships, which means that net you may not be better off in a trade that just grows faster. So you have to look at all the factors to determine whether or not the market would be higher or lower.
Okay. The 12 vessels that are coming up for repricing, and you said that one of the tenders where you intended to participate has been cancelled. So what are your plans now, and how are their prospects looking end of
So
June?
the vessels that are coming up for repricing have all been bid into businesses and are likely to get their next contracts at higher than their previous contracts. These are the offshore vessels. They've all been bid into tenders and the market is fairly tight. The one which I referred to, the tender being cancelled, is on a rate where we have just received the news of that tender being cancelled, and therefore we will now evaluate our options with regard to that rate.
Okay. So this other income of 163 crore, what is it comprising of?
So a lot of it is treasury income. We have a very large amount of cash because we have generated so much cash. So that's treasury income.
Okay. Sir, one last question before I come back in the queue. You mentioned in the slide the order book versus scrapping potential.
Yes.
As an individual investor, I mean, just can you help me understand the significance of this? For example, let's say an LPG carrier which has a high order book and a low aging fleet, okay, versus a crude tanker. I mean, can you just help me understand the significance of this chart?
Okay. So let me just go on to the crude tankers and product tankers where the order book is relatively low as compared to the scrapping potential. So when we say potential, the point is that largely over the age of 20, tankers find it hard to trade in international markets because either charterers or terminals have restrictions. Having said that, it is not necessary that those vessels will be untradeable. We often see that in tight markets, you can have a situation whereby the vessels trade longer than age 20. So as of today, you are seeing many vessels above the age of 20 but are not being forced to scrap because the rates are very high. Owners are earning much above their costs on those assets, and charterers are also willing to accept those vessels because the market is very tight. However, if the market comes down and charterers have a lot of choice and those owners with older vessels are unable to trade those vessels or they're unable to employ them sufficiently well, they may then be forced to scrap those ships. And therefore, there is a potential for the supply of vessels to come down. On LPG, it's the reverse, where the order book is high enough and there isn't many vessels that are likely to be scrapped even if the market comes down. Because even if the market comes down and your vessels are relatively young, then you will tend to hold on for a longer period of time before you come up with the decision to scrap the vessel.
So by order book, what do you mean here? I mean, you're referring to the order for the supply of new LPG carriers, the new vessels.
That's right.
That order book you are referring to. Okay.
That's right. So if you see the order book of crude tankers at 8%, it means you take the total fleet of crude tankers in the water and 8% of that is on order for delivery over the next few years. Generally over the next 2 to 3 years.
Okay. But even your
Mr. Katter, may I request you to join back the queue, please, as we have other participants waiting.
Okay, sure. Yeah, thank you.
Thank you. We'll take our next question from Vaibhav Bajjatia from Honesty and Integrity Investment. Please go ahead.
Hi, thanks for providing the opportunity. I hope